Hello, everyone, and thank you for joining in today's class. We will be continuing with our segregated fund textbook, and today we are continuing on the advantages and basically advantages of segregated funds. Okay, segregated funds have so many advantages, and the first one is guarantees. Okay, I'm going to go through this text really quick today because we still have a lot to cover, and some of us will be writing our exams on the 16th, so I feel it's important that we cover everything, before the date so that we have all the necessary information to go in there and succeed. All right, so moving on, another advantages of seg fund is the fact that it has growth secured by reset. You also have funding flexibility, guaranteed income options, professional management, diversifications, tax benefits, switching between funds, ability to withdraw funds, exceptions for probate fees and investor protection, creditor protection, absence of medical underwriting, and rights of recessions. Okay. There are also these benefits will be discussed in the following pages. So we're going to be looking at these benefits now one by one, and I'm going to, because these benefits we've actually touched on them in chapter one in one way or the other, but now that we are focusing or like zooming on them individually right now, so pay close attention as we go through them one by one. Guaranteed. Okay. The segregated funds have maturity guaranteed. Okay. Maturity guarantee is a minimum return to the investors up to 75% deposit, providing the investor contract is in force until maturity date, and is typically 10 years, okay, from when it started. All right. Now, don't get this wrong. So let's say you invested $1,000 and this company becomes inability or sorry, or your funds doesn't perform, or your funds is not doing well, right? So now the maturity guarantee, now there are two types of maturity guarantees. There's maturity guarantees and death benefit guarantees. Okay. So this 75% I'm talking about now is maturity guarantees. If you invest $1,000 and upon maturity and you are in it for 10 years and your $1,000, let's say, becomes $5,000, you have a 75% maturity guarantees. Definitely you will get 7,000, $750. Okay. You only be out of pocket for 25%. So that is maturity guarantee. Then the second one is death benefit guarantees. It applies throughout the entire term, of the contract. So this one is not a function of if you stay to the end of the term or not. It applies through the entire term of the contract. That is, if the annuitant or if the persons that the investor happens to die during the cost of the 10-year period or the investment. So and the investment is not doing well, then the person will get 75 deposit of the contract. Let's say you, again, like our initial example, you invested $1,000 and the stock, sorry, the funds now in your money now is now 650 or 600, and the person happened to pass away, then the 75% guarantee kicks in. Okay, withdrawal from the contract reduce the sum on which the guarantees are calculated, but the percentage will be 75, 75, remaining the same. So let's say if you have taken money prior, so that will reduce the amount of which the 75% will be calculated. That's pretty much straightforward. All right. So yeah, there are three parties to understanding the role of parties to the contract. Okay. The first one party is the is a person whose money, the principal, is deposited to the contract, and this person is the policy owner, and he makes the investment decisions pertaining to the contract. Okay. And then may also withdraw money or thereabout. And the second party is the annuitant. So the annuitant is if the policy owner buys the segregated fund contract in an RRSP or in RIV, he must be the annuitant. Okay. So if you buy your seg funds in a registered plan, then you have to be the annuitant. The annuitant in this case is a person that will be taking out the money. Okay. Now, so that is the second party. So of the segregation fund, so the RIF. Then the policy owner buys a contract in a non-registered plan, which is also called taxable plan account. Then the annuitant can be person named by the policy owner. Now, if your segregated fund invested in a non-registered plan, then the annuitant, that is the person that will be taking the money out when the time comes, can be named by the policy owner or by the policy owner, like we see in number one. Then the third person is the beneficiary, which is the third party of the contract. Okay. The policy owner named the beneficiary of the contract when the annuitant dies. Okay. And the beneficiary received the amount that is equal to at least 75%. So now, there's always a beneficiary named, okay, in segregated funds. So, and is applicable to both registered and non-registered plan, such that if the annuitant, that is the person that's supposed to be taking the money out, happens to passes away, then the beneficiary receives the money. Okay, so we have the policy owner, the annuitant, and the beneficiary. And just bear in mind that the policy owner and the annuitant have to be the same in registered plans. And what are the registered plans? The registered plans are like the TFSA, the RRSP, RIF. Okay, those are registered plans, those plans that are registered with the Canada Revenue Agency. And the third party to the contract is the beneficiary, both registered and unregistered plan named beneficiary, who is the person that will receive the, the payment or the money upon the passing away of the policy owner. Okay, so that is basically it. Some contracts are structured to offer 100% guarantee. Often these contracts are based on longer maturity terms. Okay, so we are seeing here now, typically the maturity period, the maturity time horizon is typically 10 years. However, there are some contract that guaranteed 100%. Okay, sorry, typically the guaranteed amount is 75%, but there are some contract that provide 100%, and oftentimes those 100%, those contracts that provide 100% guarantees are usually structured on a longer term basis, longer than 10 years. You'll be looking at 15 years and more. Okay, some contracts also, all right. Maturity and death benefit guarantees are always stated with maturity guarantee first, allowed by the death benefit guarantee. For example, when they are equal, then the guarantees are stated as 75-75, and the maturity guarantee is less than death benefit guaranteed. So the guarantees are stated in 75-100. Yes, this is absolutely true. There are some funds that provide. Hmm, can I quickly show you guys? Let me see. Because sometimes when you see these things, it makes it easier for you to, you know. Let me go to La Capitale. When I show you guys, then it will be easier for you to wrap your head around all these things I'm saying, so that it would not be in your realm of imaginations. Okay. Let me see if I can quickly do this. though I want to move really fast this morning to cover as many pages as possible. Okay, so let's see my investment. Please, I will appreciate as many of us are using this material to study and getting ready. I'll appreciate it if you can share your journey, your progress on a WhatsApp group so as to encourage the rest of the teammates. Okay. Interest rate. Okay, rates and returns. Du- 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 du. Okay, let me zoom in on this. Oops, I think I zoomed it too much. I'm not sure you guys if you guys are seeing my I don't have any funds here that does 75. Let me check with IA. I just checked the lockup. I didn't see any kind of IA Industrial Alliance. Do I need to sign in? Savings and retirement. RESP, life event, investor beta, financial compass, education. This is taking so much on my time. Okay, let me try to log in. I guess I need to get in to be able to show you guys. Please bear with me. I need to log into Advisor Center on Industrial Alliance portal, which is what I'm trying to do. Okay. Okay, sign in. You know, it's crazy. So many platforms you have access, you guys will have access to once you're licensed, and that gives you unlimited life insurance application, investment application. Okay, I'm not applying for investment. Okay, funds performance guarantee funds rates. Let's see. This might be what we are looking for. It's loading. Okay. Oh no, no, not this. Oh, this is not what I'm looking for. Okay, let me look at funds performance. I hope you guys will see value in this stuff that I'm doing right now. Oh yes, there we are. Okay, guys. I'm going to stop sharing the previous screen because I'm not sure if you guys are seeing this one now, and because nobody is here to tell me, so I have to go with my guts. Okay, so this is what I'm talking about. You see this focus prudent fund? You see, its classic series is 75-75. So it means that it gives 75% guarantee, you see, on maturity, and 75% guarantee on debts. Okay, so you see 75-75, 75-75. I've seen the ones that gives 100, So I'm scrolling down, hoping I could see one of those to show you guys. And you see the performances of this one. Oh my gosh, look at this one. Net returns year to date, 6%. Woo! Look, 11% year to date. We are just, and this is performance till May, because year to date is as at the end of May. Look at this one, Fidelity Global concentrated 11.95%. Anyways, Joy, calm down. I know if I start analyzing funds performance, we won't live here today. I love doing so anytime. Okay. Uh, a page. Okay. Can I do more than? I can even do up to 500 per page. Okay. So let's see. I'm looking for, I know I've seen funds that does 100, before. Okay. All right. Looks like all the ones here, they are 75. But I know I've seen, because there's a concept they talked about in the text, that I'm looking for the one that the debt benefit and the maturity guarantee is different, so that when you see 75, okay, you wonder, okay, which one is debt benefit, which one is maturity guarantee, so that we can use that to get this. Let me see if there's a next tab to this. No, there's no next tab to this. Ooh, look at performances. 8%. 17.69. What? Okay, Joy, calm down. Keep going. Don't stop. Don't look at performance. Just go. Okay, so I think everything I'm saying here is 75. Okay. So I'm going to go back to the text now. And let's see. Okay. Oh, here we go. I can actually filter. Voila. Gosh, I can actually filter. Okay. So is there 100? Let's see. Is there? Yeah, 100. Okay. Anyways, I'm not going to start. You guys get license and come to IA and dig in, dig. Okay, so look here. So 7,500. So when you see numbers like this, so which one is maturity guarantees? Which one is debt benefit guarantees? So I'm going to stop sharing now, and then I'm going to go back. Oh, where's my text? Oh boy. Um, where's my text? Okay, here's my text. And I'm going to go to my Zoom and share. Now I can click on my text. Share. Okay, so when we see 75, okay, that's what this is trying to explain to us. Say maturity and death benefit guarantees are always stated with the maturity guaranteed first, following by death benefit guarantees. So what is it telling you is that the maturity, so just look at it this way, the chances of your your investment maturing is higher. That is, um fewer people die while in while their contract is still running than maturing. In other words, if you have 100 policies, at least most of them, okay, reaches their maturity, compared to people that dies while their policy or their contract is still running. Now, that is not in any textbook. I'm just saying this so that you use that lens to, you know, give yourself the understanding that, okay, maturity guarantee is the first one, death benefit guarantee is the second one. Okay, if you know what I mean. I'm trying to make this as fun as possible because it can be boring sitting down listening to, one person talking and all that. So this is telling us that the first one is maturity guarantees. Then the second one is debt benefit guarantees. So if you see 75, 75, you know that this first 75 is your maturity guaranteed. Your second 75 is your debt benefit. And then in the situation whereby they are not the same numbers, okay? Like that example, I took us to Llqp and I took us to IA just to make us see, you understand, even though I was carried away with some of the fund's performances. You see, I get excited, when I see performances like that, because that's what we do. We look for the best. And if you are currently in any funds that is not doing well. You see, one of the advantages of cell phone, we're going to see it, is the fact that you can switch fonts. See what I mean? You can switch. You don't die there, and don't say, "Oh, I already have this plan." If you cannot even open a new, when as you are starting your journey now, when people tell you, "Okay, I already have TFSC, I already have my individual RRSP," you say, "Okay, I want to sit down with you. I want to see what is the performance. I can help you put it where it can do better for you." Even you yourself, evaluate your own. Start with yourself first, because I know that for all of you listening to me right now, you've taken fantastic financial steps in one way or the other in your life. So you must have had some of these plans where it is your money working extra hard, is your money putting the best buck in your pocket. All right, those are the things that Samson and myself will be sitting down with you guys, as you guys get licensed, so that we navigate some of those things in the right portfolio for you guys. Okay, awesome. So let's move forward. So just know that when the numbers are not the same, like in this case now, this provide 75% maturity guarantee and 100% debt benefit guarantee. You see, this is how you tell it. No, the first one is maturity. The second one is debt. Okay, just see, say your investment will mature first. Uh-huh. Okay, yeah? Good. You see, I just a ginger myself, as I know they to ginger me. So have fun. So whenever you guys when you are listening to this, just have fun to listen to this thing. This is not complicated. Okay. And that's what I keep telling you guys in this class. Don't overthink it, because we all have this notion that, hey, safe fun, hey, life insurance, but it's what we do every day. See, so we do every day. Some of us, even the wherever our this thing is, it may even have a maturity guarantee and debt benefit. We didn't even look at it. You understand? So you don't know. Anyways, so we've talked about maturity guarantees. Like I said, I'm going to speak through this because I've taken time to explain this already. Okay, maturity guarantee applies, on the maturity date of the contract. Okay, so you can't key into the maturity guarantee benefit until you reaches the maturity guarantee, which is typically 10 years. Okay, they say the maturity date is usually 10 years, never less. Okay, from the time of the first deposit. Okay, maturity typically offers guarantee higher than 75%. So you will always see that minimum baseline is 75%. Like when I was checking the IA, it's just that I didn't want to go and filter to the one that gives 100. You see? Anyways, there's no maximum to what value may be. So it doesn't matter how much you invest, you will still get your maturity benefit on maturity of the contract. Okay. Withdrawals are values on the investment. All right. So that is on that one. Let's keep moving on. Run. Okay, dokie. All right. So we talked about that. Okay. Extended contract. A top up by insurer is attributed to according to. Okay. This one. Did I move 2 pages forward? Oh, I didn't scroll down. Oh, sorry. Okay. Okay, so we talked about this maturity guarantees. Then, on maturity of the contract, the policy owner may withdraw the value of the investment If the market value is greater than the guarantee value, the policy owner receives the market. Of course. Ah, if my 10,000 is now 15,000, what? I'm going to cash in on my 15 grand. All right. Yeah, just so you know. And then if the value of the market, okay, is less than the guarantee, then you get the guarantee, which is 75% or 100%, depending on what the percentage of the guarantee. And when the market value is less than the guaranteed value, the insurer tops up the market value to equal to the value of the maturity guarantee. Of course, so like what this is telling us basically is that you invested $10,000, right? And your $10,000 now is $5,000. So insurance company will top up with 2.5 to come up with a 75% guarantee to give you. And if your guaranteed is 100%, the insurance company will have to top up 5 grand to give you 100,000. What? 10,000. Okay, so that is that market value contract at maturity and then the amount received. So all this is just typical to this thing. Let's see a typical question, what it looks like. Okay. Michael invested 10,000 in a segregated fund with a 75% maturity guaranteed, and the guarantee at maturity is 7,500, which is 10,000 times 7,500. Pretty much the calculations in this kind of questions is pretty straightforward. Okay. So moving on to death benefit, I think death benefit is also typically the same. You understand? So death benefit guarantee is near duplicate of maturity guarantee. Okay. In the annuitant dies, during the contract, the beneficiary received the amount that is equal to 75%. So remember, we have annuitants, right? Annuitant is in the case of registered plan. Okay, in registered plan, the annuitant and the policyholder have to be the same. So if that, so that when you hear annuitant, don't get confused. Just read the question. Most likely they are talking about the registered plan. Otherwise, on registered plan, you'll be looking at beneficiaries. Although the registered plan also name beneficiaries. So if the annuitant dies and then if the policy owner or the annuitant dies, okay, uh, during the contract, then the beneficiary received the amount of 75% or up to 100%. All right. Okay, okay. So the maturity and death benefit pretty much the same. The only thing is that who receives the money. Okay. In case of the death benefit, the money goes to the beneficiary when the annuitant die, which is the same person as the policy owner. Okay. Okay, so now they give us example of the death benefit, which is pretty much the same. In the case of 75%, pretty much multiply with 10,000 by the 75%, just like we did, in the uh, maturity guarantees. All right, let's move on. How fast should I go? I'm still in page 35. Oh my goodness. Okay, growth secured by reset. Now, some insurance offers reset on their segregated funds. And when it is offered, a reset allows a policyholder to take advantage of the increase in the market value of the fund. How does this work? All right. As the market value of the fund increases, a reset loss in the increased value, and the maturity and death benefit guarantees are based on the new contract. All right. So you invested $10,000, right? $10,000. Now, market went up so well that your 10,000 is now 20,000. So you invested $10,000 in 2020, and now fast forward 2021, your 10,000 is now valued at 20,000. So you can reset. You can reset at the current value to lock in your maturity and debt benefit based on 20,000. How does that play out? Okay, here it is. So you initially in 2020, let me see, June 13th. Sorry, I'm dating my journal to know the date that time. So on in 2020, we invested $10,000. Okay, when you invested this $10,000, let's say this fund gives you 75. Okay, maturity guarantee of 75%, debt benefit guarantee of 75%. So it means that your guarantee on this 10,000 is 7575. Then fast forward to 2021. Okay, market did so well. Your 10,000 is now 20,000. This is so sweet. You see, and that's why I love what we do, because to us, the people that come to us to invest their money, they are not just a number. We look after them and look after the fund's performances, such that when fund does so well, that 10,000 have become, you lock in, you reset this, okay? You reset this for them. And what does that do? What that makes them now, what is now the 75% of 20,000? Do you know? Let's find out together. 20 times 0.75 is now 15,000. So you see, their guarantee now is 15,000 slash 15,000. Excuse me. Oh my God. My storage is almost full. You are running out of storage on this PC. Manage storage to view usage and free up more space. Hmm. Excuse me. So when we reset, so the guarantee and maturity guarantees and death benefit guarantees now become 15,000. But the maturity date, you know, when we invested in 2020, excuse me, when we invested in 2020, our maturity was 2030, 10 years from 2020. So if we reset in 2021, so that's going to move our reset to 2031. Okay. So that's the way it works. All right. So anything else? Growth secured by reset. Yeah. So you can secure your growth, because the market that delivered 20,000 to you in 2020 can deliver 6,000 to you in 2022. In 2021, can deliver 6,000 to you in 2021. So you want to lock in that. Okay. Awesome. I like that feature though. Okay. So let's move on. This one, my system is warning me of storage, and I don't want to get to a point where everything I'm recording it's not okay. It's not saved. That's my worry. But let's keep going. Um, yeah. So reset has two effects. It has effect on the value of your guarantees, and it changes the contract maturity date. I've explained that to you. Okay. Okay, some insurers offer an automatic reset on segregated fund contract, in which insurer automatically locks in growth on the account value. All right, so some insurance company does that automatically. Okay, Doki. Funds flexibility through ongoing deposits. Yes, the deposits or premium is a principal deposit to a segregated funds, and deposit can be made through a one-time or a separate deposit, like pre-authorized deposit on a monthly basis or thereabout. Okay. The maturity guarantee may be applied to each deposit date or the date of contract the contract is signed. So when the maturity guarantee applies each deposit date, then each deposit creates a maturity date on a 10-year basis. Okay, so what this is telling us is that, okay, some insurance offer guarantee on the date, 10 years from the date the account was open. So it doesn't matter how often, how you keep making your deposit on a monthly basis from that date. And some tracks the deposit. So you're going to have multiple maturity guarantees running through such accounts. All right. Guaranteed income. A segregated fund contract typically returns an investment at a lump sum payment. Alternatively, a contract may create a guaranteed streams of income. All right. The guaranteed minimum withdrawal benefits available in two forms. One is guaranteed minimum withdrawal benefit plan, which pays over a specific period of time, or a guaranteed lifetime withdrawal benefit plan, which pays for life. Okay. So let me take that again. Okay, a segregated fund contract typically returns in investment on a lump sum payment. Alternatively, a contract may create a guaranteed streams of payment. All right, so like somebody, what this is basically telling us is that somebody may, um, after 10 years, your money may be 50,000 or 100,000 growth in your account. Upon maturity, you can decide to take your money at a lump sum, or you can withdraw that money over a specific period of time. You can say, okay, I have this 50,000. I want this 50,000 payout to me over the next 10 years. So the insurance company will tell you how much you'll be getting, maybe on a monthly basis or on a excuse me, on a biannual basis for that 10 years. Or you can create a streams of income for life, whereby you'll be getting a specific amount regularly for life. Okay. The segregator for contract may issue a one of this, okay, features of blah blah blah. Um, okay, so that is that one. They're just going ahead to compare how that is different from different by guaranteed payments and stuff like that. All right. Uh Guaranteed minimum withdrawal benefits and guaranteed lifetime withdrawal benefits. Both guaranteed minimum withdrawal benefit and guaranteed lifetime withdrawal benefit plans are based on initial deposit or deposit by an investor to a segregated fund. Investor may begin making withdrawal immediately after entering into the contract, or may choose to wait, you know, and start withdrawal at a later date. Okay. Uh, there are savings phase when you contribute into your seg funds. And then once that contribution phase is over, then you can move into when you start taking money out of your plans. All right. I'm not going to spend too much time on this because I really need to move forward. Um, the payout phase starts when the withdrawal phase begins, and during payout phase, the investor receives the annual income based on their guaranteed minimum withdrawal balance. Okay. Now, if you choose to get your withdrawal within 20 years, because sometimes people put money into their segregated funds with the intention of using it when they retire. So those are the ones. And if you're the type that, you know what, my money, I've reached my maturity, wherever is there, or wherever is my guarantee, if the market value is less than my investment, I want to cash it out and move on. So you can actually do that. And that's what all this explanation is all about. So another benefit or another advantage of segregated funds is professional management. You see, seg funds, employ professional investment managers. Many of these people are CFAs, we call them gurus that manages all these funds. They are the guys that knows the woods. They know, you see what's up. And many of them even use AI, artificial intelligence, to do many of their trades and stuff like that. So which gives, the portfolio an edge, an advantage. Okay, so yes, that's an advantage compared to you trying to manage your portfolio yourself, maybe buying stocks. Today you win, tomorrow you can lose, but these guys are gurus. They know the woods. And also another benefit of sec funds is diversification. So we have lots of funds with lots of diversifications, right? Like that time I went to IA or a la capital. If I open it, for instance, let me show you guys. Do I want to go there again? Okay, let me see. I think I've shown you guys before, but I'm gonna go to brokers, invest savings and investments. um, I'm gonna scroll down to okay, morning stars. Yeah. Okay, so let me click on one of these. Let me open it up so I can share with you guys. Okay, I'm gonna stop sharing and I'm going to reshare my screen again. Okay, I'm sure you guys can see my screen now. You see this is high yield fixed income T down. You see the diversification in these funds. This is this fund's composition. Okay. Um, okay. This fund, because this fund is fixed income funds. Remember, fixed income funds, right? You see, it has foreign bonds, cash, and other Canadian bond and US equity. Okay, because you see the percentage of the US equity. This is the geographic mix of these funds. So you're not going to see a lot of dynamics here because it's fixed income. For instance, if I go back and pick, um, is there where I can go back here? Okay, so let's look at this one. Yeah, you're going to see a lot of dynamics going through this. I hope you guys have seen my screen. Okay, so you see the funds compositions, right? Bank of Nova Scotia. You see there's the diversification here. The Royal Bank of Canada, Toronto Dominion, Canadian National Railway Company. You see OneNet Corporations, Microsoft, Franco, Nevada Corporations, Power Corporation of Canada, Canadian Pacific Railway. You see, Intact Financial Corporation. See the dynamics of this fund. See the um, what's it called? Let me go back and maybe able to see my screen. Mm, Let me go back to share my screen. You see the diversification in that funds, right? That's what we're talking about. Fund diversification. And I hope by going to okay. I see what has happened now. Every time I check this. Okay, so I hope by going to show you guys, the diversifications in the funds that I just showed you guys helps you to understand better what we're talking about here. All right, so that's an advantage. And then this another benefit of sec fund is tax, benefit of allocation. So segregated funds investing creates value for an investor in two ways. Market value of the investment may increase, and then an investor may receive allocation from a fund. So mutual fund distributes income, segregated funds allocate income. Okay. When an investor makes deposit to a seg fund, the investor receive an assigned number of units. Okay. And then the number of units received is a result of how much is invested and their fair market value. Okay, it is essential for an investor to know the value of units when they are assigned. And if the investor wishes to follow performance and monitor the increase in units, a new value, then an increase may indicate that a reset is in order. All right. And how does that value is determined is by total value of asset divided by, sorry, minus liability divided by number of units outstanding. So that's how net asset value per unit is determined. Now the entire total value of asset less liability and then divide by the outstanding unit. Okay. So that is how they arrive at that. Moving on to okay. Switching between funds. Yes, that's another benefit we get in investing in segregated funds. And I've actually talked about this earlier. You can switch your funds between funds with seg funds. For instance, if you invest in one fund and the funds is not doing well, an investor who wants to switch their account value from one seg funds to another may do so. Okay, and to a fund that is better and performing better, and also depending on their risk tolerance. Somebody's risk tolerance may be low today, tomorrow the person's risk tolerance might be high. Somebody's risk tolerance might be high today, today it might be low. So depending. Okay. So yes, you need to check with your client and see where necessary to switch their funds. All right. So then ability to withdraw or redemption. So the investor enters into a segregated fund contract with the intention of seeing their money to maturity at least 10 years. However, if his or her financial circumstances changes during the 10 year, he may find the need to make a withdrawal from the contract and to receive cash in hand. So a withdrawal is also known as redemption. So a withdrawal can be made at any time, and this provides investment flexibility, right? So yes, withdrawal process begins when the investor informs the insurer of the amount they intend to take out, right? Now, if the contract is issued with a DLC, that is the charge in force, then sorry, the time of the withdrawal applies of the contracts of the whatever will be charged or thereabout. For example, if the DSC applies for 6 years and is stated a 2% contract year 4 and a 2% charge on the amount of the withdrawal made in year 4. So if you are withdrawing your money before then or during that time, then you will be charged. Okay. Exemption from a probate fees. This is another huge benefit of segregated funds that many people don't understand. So you see, when somebody passes away, your asset actually passes through probate. Okay, it passes through probate, and the probate fees differs from province to province. Look here, it's a probate is a process in which the will of a deceased person is proven to be valid, and the person appointed as executor of the will is accepted. It occurs in the provincial home court of the deceased and is finalized when letters of probate or equivalent document is issued. Okay, so yes, you have your house in order, you have your life insurance, you have your will, but and then you've named your beneficiary. So that your will have to pass through probate to be confirmed that yes, it's accepted, and that the person you've appointed as your executor of your will also is accepted. So that process, it goes through the province where the person dies for all that process to be complete. And the provincial court charges fee for that. And oftentimes the fee that is charged is dependent on the the assets of the deceased. Okay. So probate fees are charged by the province or territory against the value of the deceased estate. Quebec does not charge probate fees. Okay, Quebec, they do their own thing. Some things I like, or some it's things like this. You want to like, okay, should we move to Quebec? Probate fees must be paid by the estate of the deceased before any property can be inherited as specified in the will. These fees can significantly reduce estate value in a province such as BC that does not put an upper end cap on the probate fees. Hey, wow, probate fees are not charged to a trust. When a surviving spouse inherits assets, when the beneficiary of a segregated funds contract is not an estate, instead, a named beneficiary receives the proceed from said funds probate free. Children and grandchildren of the contract owner or annuitant. However, if the estate receives the proceed, then they become part of the total estate value. Wow. And again, the probate also slows down distribution of assets because the segregated fund bypass probate, so the beneficiary can receive it almost immediately. Anyway, so you have it right there. Look, I took my time to explain it and also read it for you guys. There you have it. Segregated funds bypass probate. Investor protection. This is awesome. Let's say that you are owing somebody, right? So, and we see a lot of questions around this. Remember that guy when we're trying preparing for certifications, right? Now you know that his creditors were coming after him, that he went to change the name of the beneficiary from himself either to his dad or to prefer beneficiary class, right? You see, Azuri steps in to provide investor protection when insurer becomes insolvent and cannot meet their obligation. Oh, sorry, this one talks about investor protection, not creditor protection. Sorry. So yeah, for investor protection, yes, Azuri facilitate a quick transfer policy from the solvent insurer to another insurer. Okay, so investor protection in the sense that, let's say your segregated fund is with XYZ company, and XYZ company is getting to a point whereby they cannot meet their financial obligations. Azuri step in and migrate all the investors to a more vibrant insurance company in order to protect investors' investment. Um, Guarantee exceeds market value. Well, Azuri protection is needed only when the guarantees of the segregated fund investment and maturity or debt are higher than the market value of the fund. Okay. In the event of insolvent, the insurer Azuri guarantee will apply. All right. Azuri allows segregated fund contract owners to retain 100% of its guaranteed investment if it is equal or less than 60,000. For guaranteed value at more than 60,000, contract owners will receive 85% of the guarantee, whichever is greater. Mm, okay, I think I need to break that down for you guys. Okay, so your guarantee, let's say you invested okay, you invested 100,000, okay, and you have 75. So it means that your guarantee is 75,000. Okay. And now this insurance company is becoming insolvent. Okay. As Zurich comes in, because your guarantee is more than 60,000, then you get, see, Azuri allows segregated funds contract owners to retain 100% of his guaranteed investment if it is equal or less than 60,000. For guaranteed value at more than 60,000, contract owners will retain 85%. So guarantee this thing that is more than 60,000. So if you're like in this case now, your guarantee is more than 60,000, which is 75,000, then you get 85% of your guarantee or 60,000. So in this case now, this person will get the guarantee is 75,000. So it means you get 85% of your guarantee. Okay, so 85% of this guarantee is what? Let me see. 75 times 0.85 is actually 63,750. Okay, but if it's an investment that gives 100 guarantees, so it means this person will receive 85,000, which is 85% of 100,000. Okay, so the next benefit of seg fund is creditor protection. We've talked about that one. How it protects a person or entity such as a business who is owed money by another is a creditor. And then when you are owing somebody and they are coming after you for their money, your segregated fund money is creditor protected. Nobody can go touch it. Okay. And then this protection is provided because segregated funds are issued as an insurance contract, and claims would not be successful if the spouse, parent, children, or grandchildren are named beneficiary. The beneficiary has to be irrevocable, and then the account is registered account. Okay. All right. A person must not try to avoid creditor claim by investing in seg funds. A seg funds contract must be acquired for the purpose of investment, not for the purpose of avoiding creditors. So anyways, um, yeah, absence of medical underwriting. When you are investing in seg funds, um, the insurance company don't request for medical underwriting. Right of rescissions. Okay, the right to cancel a contract is known as the right of rescission. So all insurance contract provide this right, okay, to investor to rescind segregated fund contracts. Okay. So again, just note that when you resign your contract, there might be situation where you receive less than what you contributed, right? Because of some chargebacks and all that. Types of segregated funds. Okay, there are several types of segregated funds. Um, we have Canadian Investment Funds. Standard Committee classifies all funds or investment into categories by asset class. The difference is cash, fixed income, equity, commodity, and others. Okay. Okay, so this list of category is helpful to start to understand the many types of funds, since each class, share certain characteristics. You see, uh, cash, fixed income, equity, commodity, and other. If I go to this, mm, not this one. Let's say rate of returns. I want to show you guys the asset classification. Yeah. Um, Let me share here again. Okay, so you see, based on this asset class, you see we have fixed income. which is like your cash, right? Fixed income, Canadian fixed income, Canadian whatever. And then what's the next one here? Then you have fixed income. So, oops, you see fixed income, right? Then next you have what? Equity, commodity, and other. You see, when you move down here, you start seeing equity. I don't think there's commodity in this one. There are some funds that have commodities and all that. Okay, so I thought to just jump there and quickly showed you guys. Okay, so money market funds. So now remember we are talking about cash now. Money market funds. Oh yeah, money market funds are the lowest risk kind of funds, okay? And the market funds must invest in at least 95% of their total net asset in cash. Remember, the first funds I showed you guys, was it in IA? Yeah, is it IA or in, no, not IA, it's Llqp that have very few funds. Let me see if I can still see that. Um, let's see here. Yeah, I think this is money market funds. Yeah. Okay. So if I stop sharing and I go back, okay. So you see here, this is money market funds. You see, everything is foreign bond, cash, Canadian bonds, a little bit of this thing. See, it has in fact more than 95% of his this thing in money, whatever. So, and that is what this is telling us. Go back to share. Okay, so yes, he said that money market fund must invest at least 95% of their destiny in money market. Okay, government in total in their asset in cash equivalent such as government or Canadian short-term bonds or treasury bills. You can see that in the whatever I just showed you guys. Then the next in under this uh cash or wherever is bonds. Okay, I've already talked about bonds in chapter one. Okay, bonds is like IOU. Okay, bond funds are fixed income types of fund, and these funds must be invested in specific percentage of their holdings. So now we're looking at the segregated funds that invest in bonds. They will have certain percentage. Again, if you look at, oh gosh, have I left? If you look at that example, I'm not going to switch my screen again. If you look at that example I gave you, will see that they have Canadian bonds. They invest in foreign bonds. 84.7% of their asset fund composition is in foreign bonds, and then 9.5% in cash and others, and then Canadian bond 5.5%. Right. So yes, that is now we're now looking at the asset class that the segregated funds put money into. That's what we are looking at now. And the first one we look at is where cash, that is in this thing, they put their money, they can put the money in cash and all that, which is the money market funds. And then we are looking at market and bond funds now. Bond funds whereby they take this money, for instance, if they borrow money to Canadian government or international governments, and those are the asset categories that segregated funds company, these gurus can put the money. Okay. And the next one, let's look at the next one. Okay, the next one is equity funds. Equity funds is like um that category we saw. You see that they have 0.2% in equity. Again, so if a fund is 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 for what's it called? Let me go back here. So if the types of fund that a fund is investing on is cash or low risk funds, that's when you see that they have a little amount, okay, of their asset composition in equity. So like that for fund I showed you guys is a low risk fund. You see that they only have to 0.2% in equity. But the one that is aggressive funds, you see that the reverse is the case. They'll have more of their funds compositions in equity. If that makes sense. All right. So equity funds by market capitalizations. Well, the larger the market capitalization of stock, generally the lower the investing risk, right? Funds are available as a small cap with mid cap or large cap. Each invests in its corresponding types of company. All right. Then we also have income funds. So income funds are based on bonds and growths, derived from regular interest income. Okay, so these are asset class that are low to medium risk kind of thing. Then we have balanced funds. Balanced funds are funds that invest in both stock for the growth and potentials that this provides. Okay, and for safety of the category it presents. You see, all these things are things that we determine when we do investor profile for our clients. We know whether this client is a conservative fund. If they're conservative clients, then we put their money in income funds. Okay, and if they are balanced kind of investor, then we look for balanced funds to put their money. So balanced funds, take advantage of the aggressiveness of the equity and also take advantage of the low rates that income fund provides, okay, to balance them. All right, so moving on to the next one. So we look at income funds, we look at balance funds, and next one is target date funds. So target date funds combines equity fixed income investment, and this investor picks target dates, usually the date intended to retire, but it can be any date at any age over the duration of the investment. Interesting. Well, dividend funds are dividend or invest in companies that have a history of paying dividends. So dividend is distributed by the companies and board of directors or companies or shareholders or whatever. So these are funds that pay dividends. So there are funds that we invest in that pay dividend. And then there are mortgage funds. So mortgage funds are funds that invest in real estate in mortgages, right? No, sorry. Mortgage funds are funds that invest in mortgages. Like you see, we all hear only about CMAC. CMAC guarantees mortgages, but all this money that when we buy a house, let's say you buy a house of 500,000. Okay, your maybe for your down payment you bring 100,000. Okay, so this the remaining 400,000 is coming from somewhere, right? Because it's coming from somewhere and it's coming from some of these mortgage funds. Okay, mortgage funds are the ones that complete those difference to the bank, because as far as the seller of the house is concerned, or the bank takes their own money immediately right off the bank. So you see that you are owing somebody, your mortgage, you probably may not be owing TD Bank per se, because that fund may have been sourced from somewhere, but we don't have privy to the behind the scene arrangement that happens there. But the only thing is that the bank gives you the mortgage, you pay the interest rates, right? So you're investing in funds that are focused on mortgages. Your own investment might be part of what you're getting in your mortgage or something like that. Anyways, And then next we have real estate equity funds. These ones are the ones that really invest in the actual real estate, physical real estate. But any fund that invests in real estate is not a liquid funds, okay? Mhm. And then we move on to indexed fund. Index fund mirrors an index such as S&P composite index and invest in same stocks that are listed on the index market. Okay. Okay. So remember we have dividend funds, we have income funds, we have bond funds, we have mortgage funds, we have real estate funds, index funds, and we also have funds of funds too, right? Yes. Yeah, I didn't even see that. So we have funds of funds. You have funds that invest in segregated funds. So in other words, you see segregated funds, you see that invest in segregated funds. So this provides the maximum level of diversification. So in exams, you're going to see, okay, all these funds provide diversification, or the following funds, which of the following funds provide most diversifications? The answer to that is funds of funds. Okay. Then we have specialty funds. um some funds are created to appeal to specific investors. So this one is not a generic word, it's just like a customized kind of funds. And this one is when some investors have muscles and they are coming on their own terms. They want certain funds on their own terms. For instance, if Elon Musk said, okay, I want a fund that is customized for me like this, like this. So those are specialty funds. So then we also have industry specific funds. Industry specific for represent they believe that an investment manager has in a financial prospect for an existing or new industry. So yeah, and then there's a geographic specific funds. There are some funds that are tailored towards maybe some specific geographic location, maybe Asia, Africa, blah blah blah. Okay. um some of these details are not going to be coming on in the exam and say, oh, what are the composite of specialty funds. No, they're going to ask you, maybe in all these funds with these things we'll be talking since, maybe one or two questions, you see. But if you don't know, you don't know, and that's why I'm taking my time to explain it to you guys. um New introduction, where some funds evolve over time, and some varieties of funds and some funds get introduced, and for funds that have lost their appeals are closed and may be amalgamated with other funds. Again, some funds, everything that has a beginning must have an end. Some funds may have passed, their prime days, their prime time, and they are no longer vibrant, not actions. So just such funds can be closed or amalgamated to other vibrant funds or stuff like that. Well, everything that has some good side certainly sometimes have some setbacks. So with all the benefits and advantages we've talked about that segregated funds brings to table, there are some limitations as well. And some of the limitations are risks to capital, sales charges, management expense fees, penalties, and age restrictions for acquisitions. Well, we'll start with the first one, which is risk to capital. Well, yes, your segregated fund definitely have risk to your capital. For instance, in those examples that we saw, if you invested 10,000 and your 10,000 becomes 5,000, the maximum you can get is 7,500. So the risk of 2,500 to your capital is there, despite the guaranteed, right? Even the ones that provide 100 guaranteed, it comes at a fee, it comes at a charge, right? So, and there's also sale charge. You see, the charge paid to investor, paid by investors to compensate the asset, is called sales charge. Yes. So you have a load and different loads of charges that are attributed to segregated funds. See all those gurus, those CFAs that manage those funds, they are not Father Christmas now. They get paid, right? There's also front end sales charge. A front end sales charge is a fee charged at the beginning of the contract, known as front end. And front end sales charge is also called front end load, right? Um, the fee is charged to the client as a percentage of the amount investor deposited to the segregated funds contract, and it reduces the amount that goes into the actual investment. All right. Also, there's DFC, deferred sales charge. Depends on what you pick, right? There's a sales charge for less than 2 years, less than 3 years. Depends on the options that was selected during the establishment of the account. And also, there are some no sales charge options. So, segregated funds that do not have a sales charge are called no load funds, charging a higher management expense fee. All right. Okay, so the management expense fee is a combination of management fee for the funds and the operating expense and taxes. All right. Woo. Trailing commissions. Well, trailing commissions are is a sale composition fee that is incorporated in MER and is paid to this one. Nobody is going to ask you about trailing commissions or whatever. Penalties. Well, when you withdraw before your maturity period, there are penalties that is charged to their account. Now, let's talk about age restrictions. There are age restrictions for both the last age of to establish a segregated funds contract and the last age of which deposit can be made. Okay. Um, RRSP, the oldest age at which a contract can begin as an RRSP is 71 deposit. And December 31st, the person turns 71. Okay. So you can't make deposit beyond this period. All right. And then RIF, when it comes to RIF, the last age for authorized transfer for instance from all over of the spouse's RIF is at age 90. All right. Seg fund taxation. Excuse me. The taxation of segregated funds is very complex, and the following details are an overview of the taxation of seg funds. Hmm. Tax on deposit, tax on allocation, and tax on withdrawal. Well, taxes, deposits, or premium paid into a non-registered account or a TFSA for a segregated funds purchase are not tax deductible. Oh, yeah. Deposits or premiums are tax deductible when paid into a registered account. Yes, we know that. Tax on allocation. Well, investment income can be earned in both a non-registered and registered account. In a non-registered account, this form of investment income are passed from the fund to the investor, and this is the allocation as we explained earlier. The investors receive a tax slip from the investor and report the income in their annual tax return. And the investor also report the capital gain and loss on their switch. Mm. Okay, tax on withdrawal. When units of the non-registered accounts are redeemed for withdrawal, a capital gain or loss will incur. Well, the ACB will be calculated, and the insurance company will send you your receipt that you will report. Now, TFSA is an example in that no tax is declared on the capital gain or withdrawal. Okay. Mm, tax on maturity, guarantee, and death benefit. Well, Tax on maturity guarantee applies to the top up sum contributed by the insurer if the market value unit is less than the guaranteed. So when the segregated fund is held in a non-registered account, any amount paid as a maturity guarantee or death benefit guarantee top up is taxable as capital gain. What? And when the fund is a registered account, top ups are taxable as income. Okay, what is saying is that let's say you put in 10,000 and your money became 5,000, but your guarantee is 75. So the insurance company had to come up with 2,500 to make it up to 7,500 for you. So that 25 is top up from the insurance company, and that is taxable income. Okay, so we've come to the end of this chapter, and we are moving on to annuities. Okay, so I'm going to pause here for a little bit, take a break, and we will continue. I'm going to stop sharing now and stop recording.